Good evening, everyone. Welcome back to the channel. I'm back here a day later, and as promised, I'm going to issue a slight correctional video on some things that I kind of messed up on my video I posted Saturday. And the video I did yesterday, I didn't quite realize I was actually live in public format. I usually leave those videos unlisted and then post them, but I didn't mind being live because I actually got some great comments, and I'm trying to figure out how to get those posted onto the channel. So still kind of learning this StreamYard stuff. But so far, I like it. It doesn't require storage on my computer like Zoom, because currently the MacBook is out of storage. But anyway, uh, outline for tonight's video is I'm going to correctly uh, analyze SPHD, not SCHD. I'm going to save that for another video. I'd love to throw in like 3 or 4 funds, but there's only so much time that you guys are going to watch a video, right? And you guys don't want every video to be over 15 or 20 minutes. So I'm going to compare SPHD to the new fan favorite, JEPQ. And JEPQ, like I outlined yesterday, that's got, for obvious reasons, it's becoming a very, very popular ETF on the internet because it's got a 15.89% dividend. Do I expect it to last? No, but we'll see. But I am going to run my projection on that based on that 15.89% dividend. So I'm going to look at total return of SPHD, basically how you would have done reinvesting the dividends in that over the past 10 years since it's existed. And then JEPQ, I'm going to look at, can't really look at the total return because it's been flat. So since it's been flat, I'm only going to really analyze the dividend, kind of assuming that it stays flat, which obviously it's not going to. It's probably going to either drop or who knows, it may go up over time. But anyway, so let's go back to the spreadsheet that I started Saturday. I'm actually using a Google Doc now. So SPHD pays a 3.91% dividend as of Saturday. That's slightly changed because the fund has fluctuated since then. But to make the example a bit more interesting, I picked the all-time high, which it realized a couple months ago. And it could get back the way this market's going. It could get back to that very quickly. Okay, so the start price of this was $24.60 according to Yahoo Finance. The all-time high was $49.61. And as I do in these examples, in all of these examples, I analyze a potential growth of $10,000 because that's typically when you look at a fund prospectus in the industry, you're going to see a $10,000 example. So the difference between the all-time high and the start price, $25.01. I have all the historical dividend data here going all the way back since inception, and it's paid every month about a 14-cent dividend. So, and where I caught my mistake, and actually I have to thank an astute commenter on the channel, and I'm so glad that you guys watch these videos so close because sometimes there's things that I overlook that you guys catch, and an astute comment can really help me identify a mistake. But in that case, I just, like I said, I wasn't feeling well that day, and I was trying to force out a video, so I shouldn't have forced the issue. I should have probably taken more time and paid attention to what I was doing. And I'm going to do my best to not make that mistake again. But the thing is, the concept is not wrong in that, and I'm going to leave it up because even though that fund, that wasn't the correct example for that particular fund, you can easily do that. You can find funds that do that. So that could easily be a real example. Just insert another fund, basically. So, but with this one, like I said, the commenter pointed out that the dividend pays quarterly for SCHD versus SPHD, where it pays monthly. So I had the dividend data correct for SPHD, and taking a growth of $10,000, I have 3 columns here. I have the dividend only return, and then I have the fund growth only. So taking those separate, because we're going to talk in depth about total return tonight. So remember, total return is your dividend return plus the growth of the fund. And that's why reinvested dividends are so key. If you look at one of my favorite articles that I've referenced several times throughout my channel, from like the late 80s to like the mid 2010s, the S&P 500, like according to the article, 75% of the returns of the S&P 500 were from reinvested dividends, and that's because of that compounding effect. So you're going to see here, I mean, you can already kind of see the whole spreadsheet, but I'm going to go through it. If it was just a dividend-only return and the fund stayed flat, you would grow in 15 years, not 10 years, but 15 years. Growth of $10,000 would make, and the first year is easy, right? 3.91%, that's $391. But remember, when we're doing these rates, and I explained this in my very first compound interest video on the channel, when you're doing that, you have to add 1 and you add the percentage in these decimal places. So 3% return is 0.03. So 3.91% return is 0.0391. 1 is the whole number because you start out with a whole sum. So to generate compound interest, that's really all you're doing. You're multiplying 1.0391 times 1.0391 over and over again. And in effect, it would be the same if you remember from like math class. It would be the same as 1.0391 raised to the 15th power. It's just compounding. It's multiplying times itself over and over again. And that's how compounding works. That's why it's like like the eighth wonder of the world, like some say. But anyway, so year 1, year 2, year 3, and you see by year 15, you've grown to 17,777, the 4 sevens. That's a lucky number. And then I computed the total return of the fund over 10 years. So I took the $25.01, so it's more than doubled in this time frame. So 2501 divided by 2460 yields this. Divide this by 10. Yeah, divide this by 10. I'm redundant here a bit. Oops, don't want to do that. I'll just leave it alone. So it's 10.167% per year, and that's based on the all-time highs. I don't want to split hairs, and it's actually you could go to now and it's like 9 point something, but like I say, I just wanted to make the example I guess look better, so I picked the all-time high, which it's like I say, in this market it's not conceivably off that it could reach that again within the next month. I mean, who knows? Now, I will say this on a side note, we are more than likely headed for a very rocky September. September historically is one of the rockiest months of the market, and some of you probably think it can't get much more rocky than it was this past month, especially after the Jackson Hole conference put a huge hole in the market returns. And I'll have another video coming on that. But if you look at, so the 10.167% annually, just this alone, we're kind of segregating dividend performance from fund performance. And I think a lot of people that bash dividends don't quite master this. The basic like stock valuation model that they teach you in finance class factors in your dividend growth and your total return. That's the key, total return. Dividend return is part of the stock return. Now, there are some stocks that don't pay dividends, like, Berkshire Hathaway, and you can make the argument that, okay, those are reinvested and it compounds just as well. Well, if you get a dividend, just do it yourself, reinvest it yourself, right? But anyway, so with the 10.167% compounded annually for 15 years, you have 42,734. Now, what you're going to find interesting, what I have in column F is the total return is more than the sum of D23 and E23. If I add these two together, I get 60,511. Because why is that? Because the annual dividend return added to the fund growth per year, that is the total return compounded annually. So you see that's a $12,000 difference. So taking 10,000, adding the total return of 14.08% from year to year. And I'm using a more kind of simple return. I'm not getting into like Kager here. But this is basically, this is fair enough. I'm adding the dividend percentage to the total return of the fund, right? So year 1, 2, 3, all the way down to year 15, that's a 7.2x. So you see these crazy examples that I seem to come up with, they're not really that far-fetched. Because this is real data over the last 10 years. Now, granted, we did have probably the best bull market in history over the last 10 to 12 years. So whether or not that's an outlier remains to be seen. Now that I've discussed SPHD, I've kind of really hammered that point home. I'm going to compare it now to JEPQ, the new hot ETF. So, and again, one reason and one reason alone why this is so hot online, 15.89% dividend. And just in case you don't believe that, I'll pull that up right here. And like I said, there's not a lot of historical data to go on because this is so new. But look at this. As of today, 15.89% dividend yield. So if we look at the maximum here, Uh, you see it's basically traded sideways. It's actually slightly down from where it, hold on, that's the 1-day view. Come on. From May the 4th, it's actually trading down. But if you were to draw a trend line, you can't really map out a trend there. It's almost pretty much a straight line at, like $48 or so. So yeah, it's pretty much traded flat. So I'm not going to factor in any kind of return for this example. All I'm going to do is factor in the dividend return. And what you're going to see, interestingly enough, in this example, is that the dividend return alone yields a 9.1x over 15 years compounded annually versus the total return of the other one. And that's because the dividend is so high. And this is why I keep beating the example of QYLD. That's why I keep hammering that one home, because even though that one may trade flat, the dividend return alone is generating a better overall return than this one over here. Granted, obviously the fund is probably outperforming in terms of market performance. It's outperforming JEPQ, but the dividend is smaller. So again, total return is less. Now it's not much less, 14.08%. And let me make this bigger. 14.08% versus 15.89%. But what you'll notice, and I'll just do this on the fly here because it's fairly easy to do, this 1.81% compounded over 10 or 15 years makes a big difference, even though it seems like a low amount. If we were just taking $10,000, 10,000, we'll start with this, and then we'll just do the 1.81%. Remember, this is the difference between the 15.89 and the 14.08. So it's going to be 1.0181. So year one, and watch this. Let's see if this adds up the same. Let's see. This is year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Oh, I got to delete one. Is that right? Wait a second. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I got to make sure it's right because some of you guys will look and say, oh, you added another year. Your example's invalid. But anyway, let me move this down here real quick. Down here, just to make it more uniform. Maybe I can sell this on Patreon. Okay, so 12. So here's the thing. So you see it's an extra $3,000 here, but factoring in over here, you see the huge difference compounded annually, adding into the rate over the same time frame. It ends up almost being a $20,000 difference with 15.89%. So see year 1, 2, 3, all the way to year 15. See how that works? I mean, this basically doubles in, let's see, year 1, 2, 3, 4, in 5 years, it's doubling. In 10 years, it's more than doubling from its original value. And you see, it gets so much easier at a high rate like that. I mean, that's like gold. I mean, that's almost like, winning the lottery in a sense, but it takes more time because you have such a high rate of return compounded annually. That compound interest magic is going to work a lot faster. So anyway, wanted to clear that up, and hope you enjoyed that. If you did, please remember to like, comment, and subscribe. And on this StreamYard, I'm probably getting comments, but I'm not able to really switch over to read the comments because I'm only on one screen. So don't think I'm ignoring you if you commented. Appreciate every comment I get. Keep an eye out for the next videos, and hopefully we can buck the trend in September. That's only a day away, so hopefully we can buck the downtrend in the market. So again, thank you for watching, and like, comment, subscribe, and take care.